For my column for This Is Money this week, I'm responding to a reader who reached state pension age last summer. Because she was still in work, she decided to put off or defer taking her state pension, which you're perfectly entitled to do. To defer, you don't actually fill in a form, you simply don't claim your pension and it's automatically deferred. Well, roll forward to this year and our reader decided that she did want to claim her pension, and that should have been a straightforward job. But it turned out to be anything but, and she talks of 20 phone calls to DWP and being reduced to near tears by the frustration of trying to get answers. One particular issue for our reader was the way all of this would be taxed. Now, the simple thing to do with putting off your state pension is simply receive a bigger pension when you finally receive it, a sort of reward for deferral. And in that case, things are fairly straightforward. Your state pension, when it starts at the enhanced rate, is taxable income like a wage or a company pension, and therefore what HMRC do is add up all of these taxable sources of income, knock off your tax-free allowance, work out the tax due, and then collect it month by month through a tax code applied to either a wage or a company pension. But our reader chose to do something different. Although the general idea of taking a lump sum when you put off your pension is gone, you can still backdate your pension claim for up to a year, and then that will be paid out to you as a lump sum. And so our reader said she wanted to backdate her claim to last July, and then she would receive a lump sum and then a normal rate of pension going forward. She assumed that by receiving the lump sum this year, she'd be taxed on it this year. But it turns out that's not the case. What HMRC do when people receive these kind of arrears of pensions is tax them on what's called an accruals basis. That's to say you're taxed on when you built up the entitlement to the pension rather than when you actually got the money. So in this case, the right thing that HMRC actually did was said, well, we'll treat you as if you'd been getting the money since last July and we'll issue a tax bill on that basis for last year. And I'm afraid our reader will have to pay that out of the lump sum that she's now received. Similarly, for the first few months of this year, although she didn't actually get the pension, it was payable because her claim started last summer, and HMRC will collect tax as if it had been paid. They'll use the tax code to do this. When I explained all of this to our reader, she did understand, and her question was, well, why did nobody tell me any of this? And I think it strikes me, this isn't the first time I've come across this situation. Although you can understand why DWP would say, well, we're the pensions ministry, we just pay pensions. If you want to know about tax, ask HMRC or go on gov.uk. But given that they're dealing with this sort of thing all the time, how hard would it be for them to say to people who are claiming a deferred state pension and thinking about this 12-month backdating option, you do realise, don't you, that if you do that, you will be taxed as if you'd received the money on time, so you may get a large tax bill that you'll have to pay now. It wouldn't be too hard, and I think it's something DWP should start doing.